A special thank you to each of our subscribers who make this channel possible. Here's today's story. In a dramatic escalation of tensions between the White House and the Federal Reserve, President Donald Trump has threatened to remove Fed Chair Jerome Powell if the central bank does not comply with his demands for immediate interest rate cuts. This unprecedented move has raised alarms among economists and analysts, who warned that it could destabilize U.S. financial markets and undermine the independence of the central bank. Trump has been vocal about his desire for the Fed to cut rates in order to stimulate economic growth amid his controversial tariff plans. During a recent press conference, he stated, "If I want him out, he'll be out of there real fast. Believe me," referring to Powell, whose term as Fed chair is set to run until May 2026. Powell, however, has made it clear that he has no intention of stepping down and insists that the independence of the Fed is crucial for effective monetary policy. He described this independence as a matter of law, emphasizing the importance of the central bank operating free from political pressure. The conflict has drawn mixed reactions from economists, with many agreeing that the administration's tariff policies are likely to increase inflation and slow economic growth in the short term. Stephanie Roth, chief economist at Wolfe Research, expressed skepticism about the Fed yielding to political pressure, stating, "I don't think the Fed is going to succumb to the political pressure." Legal experts also weigh in on the implications of Trump's threats. Many argue that the president does not possess the authority to dismiss the Fed chair without just cause, as established by the Humphreys executor case from 1935. This case reinforced the notion that independent agencies, such as the Federal Reserve, are insulated from direct political interference. If the Trump administration were to succeed in challenging this precedent, it could have far-reaching consequences for the Fed's autonomy. The bond markets are also a critical factor in this unfolding drama. Recent market turbulence, triggered by Trump's tariff announcements, has led to a surge in U.S. Treasury yields and a decline in the value of the dollar. This shift signals that investors may be losing confidence in the U.S. as a safe haven for investments. As the administration navigates these challenges, it has paused plans for additional tariffs against several countries, a move that has helped to stabilize financial markets temporarily. Analysts emphasize that the bond market is a powerful force that cannot be easily manipulated. Diane Swonk, chief economist at KPMG, noted, "You can't control the bond market. And that's the moral of the story. And that's why you want an independent federal." The stakes are high as the conflict between Trump and the Fed continues to unfold. Economists are closely monitoring the situation, as any disruption to the Fed's independence could have dire consequences for the U.S. economy. With inflation remaining above the Fed's long-term target of 2%, the central bank faces a delicate balancing act as it considers its next moves. The outcome of the showdown will not only impact the Federal Reserve's future, but also the broader economic landscape in the United States and beyond. As tensions rise, one thing is clear: the relationship between the White House and the Federal Reserve is at a critical juncture, and the ramifications could be felt for years to come. That's all for this story. We upload videos every day covering many different subjects, so hit that subscribe button to stay informed. Thanks for watching.